hello, good evening. Welcome to UK Prime Time. So, today, as promised, we are going to go into episode 2 of Rift Before You Quit, the educational series that we are going to start with episode 2 today. We understood on Friday we had a word about how we basically built why we built Rift. It's all about execution. So, and today we are going to talk about risk. So, in today's session, it is going to be very interesting, and we will deeply learn and understand about risk. Risk in the sense of execution, not stop loss. Usually, when we think about risk, we we confuse it with stop loss in trading. So when we go on Binance, when we go on Bybit, when we go on Forex trading, let's say we go on MT5, we see what? We see charts, we see figures, we see stats. And using these charts, using these graphs, basically you trade. And these charts, they show you how the market is moving, how the platform is basically giving you advantage in terms of access to the market. And before we get into access, before we understand it deeply, I have a question. How many of you have blown an account, blown a trading account? Blowing means gone to zero. Honestly, raise your hands. Let me see. I'll also raise mine. How many people have blown their accounts ever? Let me see. I'm also in the list. So we are 10 people. Okay. So I hope you all, I mean, it will make more sense to you now because accounts don't blow from bad trades, they blow from bad structures of these trades that we execute. So we saw what trading platforms they offer. We all have used Binance, we all have used Bybit, we all have used different centralized, decentralized exchanges. They show charts, they show indicators, they show order panel, they show market movement, but they don't tell you how much total capital is at risk whenever you trade, and they don't tell you how your trades are correlated. They don't even give you exposure of your risk, how it is distributed. So So the question is, these platforms are, I mean, if they don't show you all these indicators, if they don't tell you, they don't talk about risk, they don't talk about execution, what are these platforms built for? These platforms are basically built for execution, not capital management. So at Rift, what we do, we have not built something different. We have built the similar ecosystem or similar structure in which we show you every single element that is available in the centralized exchanges, that is available in the execution systems that are present in the market. On top of that, we give you strategized, structured execution, and that's where we stand different. And if we compare different exchanges, it's all different UI, but the same engine, same tech, same problem, same tools, but no structure. And you are expected to behave like a professional without being given professional systems. So if you all remember the trading journey outcomes from the first session, you all can understand it more deeply now. There are only three kinds of traders in the whole industry: people who overtrade, who decline, the people who, um, tend to follow the random discipline, they show a flat scenario. The people who follow structured, who have structured system, or you can say the professional traders or the institutions, they are in growth or they are in profit. And this is not hypothetical data, this is behavioral outcome of trading. It's always over trading that leads to decline, random discipline that shows flat behavior, and structured system leads you to growth. Now let's take deep concept example in which we'll be able to compare two different scenarios in which we have one case with $1,000, we have second case with $1,000. There are two accounts, or you can say same capital with two strategies. There is a case one in which there is $1,000 trade in which risk is divided into one. Sorry, there is no division of risk. It is just one trade of $1,000 in which there is risk of 100% of account. If that account gets 50% down, then you have lost as a retail trader 50% of capital. In case 2, there is $1,000, but that is divided into $200 each in 5 trades, where there is distributed exposure, where risk is 20% per trade. What is the advantage of doing this, or what is the shortcoming of putting such trade? Can anyone try? I would like to hear from people. What is the shortcoming of putting $1,000 trade? Anyone wants to?
Can I say something? Can I
Yes,
respond
please.
first?
Yes, please.
So if you're putting everything in one trade, you have
Mm-hmm,
50% chance that it goes
mm-hmm,
right and 50% that goes wrong. So in one chance you can lose everything or you can win everything.
mm-hmm. And what happens when you lose 50%? Let's say, for an example, how much you need to, how much would it take you to recover that 50% loss?
Um, and if you have put the full if the thousand was the full thousand, you have to bring the full thousand back.
Of course. So, very simple. If you lose 50% in this scenario, then you have to make 100% more to recover your loss and to stand at even, let alone profits. And that is the core reason why retail traders, when they fail, they run away. They just pick up their bags and they run, because all it requires at this point is to make 100% again. And that's not a barrier, that's not a challenge, that's where the it's just like doubling your money with your skills. And your skills can be used where? Can be used on exchanges where you have charts, indicators, order panel. These exchanges, these platforms, they do not tell you how much of your capital is at risk, at what time you should exit, at what time you should enter, what should be your slippage. These all indicators, they just pointed to your own analysis, your own skills. And as a retail trader, you don't have a professional expertise in trading. So that's where the accounts they get blown, and that's where traders they run. So, and whenever the risk is distributed, and the core reason why we have small take profit, small stop loss inside Rift is this only, and that's distributed exposure, wherein you don't risk your capital in one trade, you don't risk your whole you know risk appetite into one execution. So always distributed exposure wins, and it has advantages. Multiple trade means multiple opportunities. Loss in one trade does not hurt much. Easier to stay consistent and lower stress and better decisions. Even if you are going with distributed exposure and you lose in one or many trades, you are not in too much loss. If you are at case one, then if you lose like a 50%, that's your 100% rundown, that is yet to take you to the even point where you started. So this is the core reason why traders, when they fail, retail traders, they exit. So same capital at a completely different risk. So if all your trades moves against you together, never you were never diversified. Okay, so let's bring real numbers to this. The reality of retail trading. Um, so this is the stat coming from biggest centralized exchanges and decentralized platforms as well. 70 to 90% of traders they lose money, and most of the account don't last for 6 months. Over 50% hit drawdown. So around 50% of accounts that hit at least 50% drawdown are around 52%. So now you can understand and imagine if around 52% people reach a 50% drawdown, then all it takes for them to achieve their even point is to make another 100%, and that's why they stay put there and they continue to hold the position even they get into loss. Or if you recall the diagram, the whole growth cycle of a retail trader from last Zoom on the first session, then you remember if a trader wins, then they start they come into overconfidence, and then they start taking bigger risk, and the moment they start taking bigger risk, they start over trading or aggressive trading, and that's where they hit drawdown. And these people at drawdown needs to have another 100 or 120% more profits to reach their even break even, and that's why the odds are never in their favor. So you have to trade smart, manage risk, and survive long enough to win. And today we will talk about Rift, how it takes you, how it reciprocates as a very sustainable ecosystem. And I have designed these training sessions according to the questions, queries, and feedback that comes from community. So, and this is not a skill issue, this is a structural failure. So, same thing. If you lose 50%, how much you need to recover? That 100% again gain you need. This is why most of the traders they never come back, because mathematically they're already out. Let's understand the professional model, and let's see deeply how hedge funds don't do what you think, and let's understand how hedge funds they work and what they actually do. Typically hedge funds, if you see yield platforms, hedge funds, different capital market funds, they provide consistent returns over time. The reason is they do not chase big profits, or they do not even chase profits. They chase consistency and capital protection. That is their forte. Not profit making is their forte, or their whole ambition, their whole strategy is not does not even contain greed or any percentage in terms of profit, and that is the reason why these funds are able to consistently give you returns, or give holders returns for years and years, because they are good at capital preservation. Typically, if we see hedge funds, 8 to 15% APY is a good return in hedge funds, and if we see exceptional returns, that's around 20 to 30%. Um, and that's where the compounding also happens. And this is the reason why these funds, they uh, operate consistently for years and years, because they have to stay in the game and do compounding and do the heavy lifting. So, uh, fundamentally, they do not chase profit, they protect the capital. So, and then we talk about Rift. That similar thing that we do at Rift is we have the similar scenario. Um, This is the reason why we have three different strategies at Rift. And so, not all your capital is exposed to one trade or one different strategy. Even strategies are subdivided into smaller and divided, or you can say fragmented trades. That is the technical terminology that we use for small ticket size trades. So, fragmented ticket sizes and multiple strategies, multiple flows, that keeps your capital diversified. So, there is controlled execution in Rift, and that's where you see there's a whole flow system that is designed inside Rift that divides or that diversifies your capital, your funds that are at work into three different risk factors: high risk, low risk, and medium risk. So instead of one trade, instead of one strategy working with your fund, we have fragmentation inside strategies. But overall, there is also three different models in which Rift auto trading engines they work, and these strategies they bring you different uh, fragmented trade, and that distribution of fragmented trades, they uh, collaborate or collude into one yield every single day, and that's the reason why it is sustainable, because we at Rift, we do not chase profits particularly, we chase consistency and protection of capital. We just make sure that even if 15 cents of profit is booked, a profit is a profit. And if that 15 cent of profit is booked consistently over the whole day, over the whole night, then we are good. We are very sustainable system that can run for years and years to come, just like a very active hedge fund. So this is how the auto trading engine is actually does actually work, and that's why there are the whole purpose of having three different flows is this. So different risk behaviors, and in the auto trading engine also you have multiple assets, multiple, this is the fragmented trades that I was talking about. So this is how professionals they trade, not one decision but continuous execution. So capital strategy. This is the reason we have, and that's why I suggest everybody to have a license for all the flows at once into your one account. If you have all, then you can divide your capital into three different strategies, and that's the most diversified, or you can say the best way to allocate your funds into different strategies. And we have three models: conservative, balanced, and aggressive, and that's how you can basically fragment your capital and reinvest, or keep on uh, you know moving on with the reinvestments in one or more strategies at once. So, and then there is compounding impact also. So you are basically not choosing traits, you are choosing a behavior. Many people ask, many people have, written to me about, um, you know, we don't have to choose trades, we don't have to select assets. Basically, you are choosing a behavior with which auto trading engine works. So let's take a real impact example. If system gives you, for an example, it gives you 1% every single day, or 2% every single day, or 3% every single day, 0.5%, 0.8%, whatever percentage every single day, and you compound it for 30 days, it is 35%. It is more than the number of days that you compound. And if you compound it 90 days, that's 145%. This is why systems they win, because they stay consistent. So consistency with structured execution with intelligence layer working together is auto trading engine. I think with 10 or 15 more sessions of these trainings, you all will have very established clarity as to how auto trading engine works, and why it's a very sustainable built up that we have created, that we have formulated with intelligence layer, with three flows, and with execution layer that hunts for profit, not just in crypto but in stocks, in forex, in commodities, everywhere. Now let's talk about um, we have now a little detailed, or you can say a little surfaced understanding of how retail traders they trade, how professionals manage the capital, how structured systems they execute trades, or they execute their operation. And Rift sits here between human intention and system execution. So in the next session, likewise, we are going to break down how auto trading engine selects trades, and what logic drives execution, and how AI fits into this system. So another 30-minute session is coming tomorrow, in which we are going to break down these factors tomorrow. But before we do that, I before we sign off for today, I want to announce. I hope my screen is visible. Futures
It
trading
is.
on Rift. So there is one more feature coming next to swipe in Rift. This will be futures. In this, you have complete manual setup of trading. You can select asset. You can manually take leverage. You can set take profit point. You can set stop loss point, and you can execute a trade. Let's say you want to trade in Bitcoin with 40x leverage at stop loss of 0.1%, 0.2%, and take profit of 0.5 or 0.6% according to your learning understanding in manual trades on Rift. And I think this you should do once you reach up to the badge of pro trader in Rift. That's when you should go, in the open ground on futures. So I would not recommend everybody to start trading with individual assets in futures from day one, but first practice in demo, then go on real trading mode. Practice with cards. Once you are really good at sniping profits in manual trading with cards, then you should go big in the futures. And that's for professional traders we have built. And everything in a self custodial setup, just like a centralized exchange with no KYC. I think it's a very beautiful, uh, you know, system that we have designed. I don't think there is any decentralized setup that offers such services, and that too very fast and very deep in terms of liquidity. Rift provides you direct access to expose or to exploit Hyperliquid ecosystem with its you know with its application, and simply you can trade in all the assets that are listed, that are registered on Hyperliquid at
Recording stopped.
multiple leverages independently on futures. So futures is coming, hopefully within this week we are going to launch it. um, Plus, okay, so I have more announcements that I will make tomorrow. So let's wrap this up today, Joe.